Good evening, everyone. My name is Jan Sveinar. I'm a professor and director of the Center on Global Economic Governance here at Columbia. And it's a great pleasure to welcome you all to the Kenneth J. Arrow lecture series. As many of you know, the Center on Global Economic Governance has been sponsoring this in partnership with Program in Economic Research, the Initiative for Policy Dialogue, and Columbia University Press. In fact, this has now been an annual event for about 9 years. We're honoring Ken Arrow, who is Professor Emeritus at Stanford University, a Nobel Prize-winning economist whose work has ranged over virtually every topic you can imagine in economics. It's mostly in theory, operations research, focusing on areas such as social choice theory, risk-bearing, medical economics, of course, general equilibrium analysis, inventory theory, economics of information, and innovation. He was one of the first economists to note the existence of a learning curve. He's also showed that under certain conditions, under conditions which there is existence of general equilibrium, and in 1972, together with Sir John Hicks, he received the Nobel Prize in economics. Ken Arrow has profoundly affected virtually every generation of economists that has come after him, and the lecture, which is now in its 9th year, is an honor of Columbia University for one of its most illustrious alumna and his innovative spirit. Now, today's guest lecturer, we always have a guest lecturer, will be John Geanakoplos from Yale University. He's the James Tobin Professor of Economics at Yale. It's especially meaningful because John received his PhD at Harvard under Kenneth Arrow and Jerry Green, and John has had a very illustrious career ever since that time. He was awarded the Paul Samuelson Prize in 1999, and he also received awarded the first Bodasaki Prize in Economics in 1994. That's the prize awarded to best economist of Greek origin who is under 40. So his research is characterized, again, very broadly by incredible variety of topics, including his personal experience in financial economics, which has motivated much of his research. And in his lecture tonight, John will be discussing an equilibrium model of credit and argue a case for why central banks should refrain from setting riskless interest rates and forgive unpayable debts. The lecture then will be followed by a discussion with Ken Arrow, Taco Santos, who is the David L. and Elsie M. Dodd Professor of Finance here at Columbia University, and Joseph Stiglitz, who is University Professor here at Columbia and Nobel Laureate in Economics. So once again, thank you all for attending here, and join me in welcoming John Geanakoplos.
Well, thank you, Jan, for that introduction. I'm incredibly lucky, I think, to have such a distinguished panel of discussants. I should be discussing them instead of the other way around, but Tano is a rising star in economics who I see from time to time quite regularly in the Financial Roundtable, where he advises the president of the New York Fed. Joe Stiglitz. I think I first heard of Joe when I was a senior in high school applying to Yale College, and I heard that Joe was the youngest professor ever to get tenure at Yale. I've learned more from Joe, I think, and Joe's work than from any other economist outside my advisors. I had quite a distinguished crew of advisors, including Herb Scarf and James Tobin. But among them all, I admire Ken Arrow the most. And his work I've tried to, in my small way, to imitate. It's inspired me, and I'm so touched that after all the time he lavished on me as a graduate student, 35 or 40 years later, he's still paying attention to me and still looking over my work. And I should also thank Michael Woodford, who's the one who called to invite me to give this talk. Michael, I think, noticed that the papers I'd written about the leverage cycle in 1997 and 2003 had a message about the recent crisis of 2008, 2016. I think he single-handedly rescued my earlier work from obscurity. So I'm very grateful to Michael. And by the way, I'm also grateful to Michael for the pleasure of teaching his daughter, who's one of the best Yale undergraduates I've ever taught. So I'm going to talk about leverage cycles. Well, there's the title, you can see. And I'll explain to the talk what these three words mean. And this is an outline of the talk. I'm going to begin with the introduction, which will be the longest part of the talk, and then explain what these words are. And I'm going to end up talking about the Greek crisis. But mostly, it'll be about how we got into the American crisis of 2008, 2010. And as Jan was saying, what it means for how the Federal Reserve should be run. So if you read the newspapers about the Federal Reserve and macroeconomics, the message you get is that the interest rate is the key to everything. Everybody wonders now, when is Janet Yellen going to raise the interest rates? The idea is that everything's driven by demand. Demand can slacken or suddenly grow, and the Fed has to even things out. When there's too much demand, it raises the interest rates. When there's not enough demand, it lowers the interest rates, and that's the cycle the Fed's dealing with by adjusting the interest rates. The idea is that credit cycles are caused by too much demand, and the Fed should adjust the interest rate. You can see right away that there's a problem with that view of the world, because if it's true, what does tight credit mean? Nobody thinks that tight credit means just that the interest rate is too high or too low. I think the typical business person will tell you that tight credit means that a lot of people who are willing to pay the riskless interest rate set by the Fed, they can't get a loan because the lenders are afraid they might default. So default is missing from macroeconomics, and that's going to be the subject of my talk. If lenders are worried about default, they're going to try and do something to make it more likely they'll get repaid. Often that means they're going to ask for collateral. So whether there's enough collateral depends on the ratio between the loan and the collateral. So that ratio is called the loan to value. Now, if you have a $100 house and you borrow $80, that's 80% loan to value. You've put a down payment or margin of $20 out of 100, that's 20%. And the leverage is called 5 to 1 because with $20 you manage to buy a $100 house. All those things basically are different words for the same thing. So every business person knows that if the house goes up to $101, that's a 1% increase in the asset, that's the collateral for the loan. And then you sell the house, you sell it for 101, you pay back the 80, that leaves you with 21. So on your $20 investment, down payment, you've made 5%. So the leverage multiplies the rate of return. The rate of return on the asset is multiplied by the leverage to give the rate of return that you make on your money. So of course, if the house went down by 1%, you'd lose 5%. And that's, even Shakespeare, I believe, understood this idea of leverage. Now, as a graduate student, I never once saw the word collateral. Even in finance classes, they didn't mention the word collateral. They occasionally mentioned the word leverage in the capital asset pricing model to say that you could make your returns look much better by leveraging, just as we saw, but of course you ran the risk of making them much worse in case the assets went down in value. So there was no connection between leverage and macroeconomics. Now, I myself didn't see any connection until I decided in 1989 to try my hand at looking at the real world. Until then, I felt it was an advantage to know basically nothing about the real world. It would keep my thoughts pure. And so after some thought, I went to a small investment bank named Kidder Peabody, because I had a little cousin who had just graduated from Harvard College and who introduced me to the guy who interviewed him, who was the #2 person at Kidder Peabody. So while I was there, I had a good time talking to that #2 person, and at the end of the year, when I went back to Yale, he asked me if I would help reorganize the research department. So I was kind of looking over the research department for 5 years, and I began to follow what was going on at Kidder Peabody. And it turned out that my cousin, by the way, then became the head of mortgages. He was 23 or 4 years old, and the other guy above him got fired, and they weren't doing anything in mortgages, so they let him be the head. And he very quickly built it into the biggest mortgage department on Wall Street. And I don't have time to explain how he managed to do that, but I had no choice but to follow what was going, and there was collateral everywhere. A mortgage is a loan collateralized by a house. What he would do is buy pools of mortgages, use those as collateral, split them up into tranches, and sell those pieces off. The buyers of the tranches would use the tranches they bought as collateral to borrow money to buy the tranche. Collateral was, I couldn't avoid collateral looking at Kidder Peabody, and I realized, that I had never seen that in graduate school. So then I came on this, I decided to introduce something that I called collateral equilibrium, which I'm going to tell you about. But then so it didn't get published till '97. So more surprisingly, in 1994, after 135 years, Kidder Peabody went bankrupt. The whole firm collapsed because of this rogue trader in the government bond department named Joe Jett, and the scandal that caused. So I didn't really know what was going on at the time. I went back from Yale to the research department at Kidder. I invited each person in and said, "The firm's closing, you're fired, you're fired, you're fired." And after the 75th person left, I went next door, and the guy said, "You're fired." So 6,000 people fired each other. That was the first financial crisis I'd ever been part of. And I didn't understand how it had happened. So my cousin decided that we should found a hedge fund called Ellington Capital, and Ellington Capital would buy the very tranches that Kidder had been creating all those times. In 5 years running the department, he created almost over $500 billion worth of these pieces. So we had a lot of things that we could buy, and we figured we could know how to buy them because we made them. So anyway, that's what we did, founding Ellington Capital. And things were just booming along. After every crisis, it seems things, if you survive, and this was a new fund, you do very well. And then in 1998, there was another crisis, long-term capital. You may have heard of the famous hedge fund run by these Nobel Prize winners. Not these Nobel Prize winners. Merton, Scholes. So they they got a margin call. They couldn't pay, and the firm went bankrupt. And it was a very famous episode. We celebrated because they were they did a lot of things, but they also did mortgages. So one of our competitors was gone. Well, a few months later, we got a margin call, and we almost went out of business, but we managed to survive. There was the margin call. We couldn't pay the margin call. We called up Warren Buffett, and we said, "It's so unfair. They're making this margin call. They said that they're changing the margins, and we have a contract. They can't change the margins. It's so unfair what they're doing. They're going to force us to sell all these things at incredibly low prices when they're really worth much more. Why don't you buy a part of our firm and, make the margin call? You can just have a part of the firm. If you just help us make the margin call, you'll get a good firm, good bonds, everything." He said, "What day is do you have to sell the bonds?" We said, "Well, Tuesday." He said, "I'll show up and buy the bonds," so that we were going to be forced to sell at low levels. So it was the second crisis I'd been involved in, and I thought, this couldn't really be all my fault. There must be some thematic, reason why this keeps happening in these markets that use collateral and leverage and things like that. So the next crisis was in 2008. Ellington was still going on. Again, we nearly went out of business, but again, we survived and did well afterwards. But this is the time when I finally realized that forgiveness was an essential part of this leverage cycle. And I testified in Congress 3 times. Have I done something terrible? I testified 3 times in Congress about forgiving mortgage debt, and 17 hedge funds got together and testified. I testified as a professor, but I got them together, and they testified that they themselves wanted to forgive the debt. Even though they were the bondholders, they wanted to forgive it. It would be better for them and not just for the borrowers. But we didn't forgive a single penny of subprime debt. So I gave the graduation speech in 2010, I think, in the University of Athens Economics and Business School, and I said, more people got thrown out of their houses for defaulting in America, didn't pay their mortgages and got kicked out, more people in America than there are people in all of Greece. You shouldn't feel that bad that you're having trouble. And I said, it's still possible they're going to forgive some mortgage debt in America, and that's obviously the way to get us out of the crisis quicker, and that's what probably should happen in Greece too, to get Greece out of the crisis. And I think maybe it even will happen. So a few years later, turned out that one of the professors who heard my talk, by the way, I should say that I was given 5 gold ancient coins as thanks for giving my talk and an honorary PhD, and I took them to appraise them, and they were counterfeit. But anyway, so one of the professors who was at the talk then became Minister of Finance. He's still Minister of Finance, Euclid Sakalotos, and he asked me if I would help with the Greek debt negotiation that just finished. So I'm going to end by talking about that. But I thought and thought and thought after all these experiences early in '97, I was first thinking about that in 2003, what is the connection between leverage, collateral, and macro? Why does this seem to have macro consequences? And the answer that became clear to me was that leverage causes asset prices to go up. So the more leverage that the economy is giving, the higher the asset prices are going to be. And therefore, the bigger the investment will be in the things whose prices have gone up. And somehow, I think a lot of people would think that's reasonable, but it was never in any of the standard economics literature and textbook that I was reading. So asset prices could go up and down, and I'm going to argue to bubble levels and to crash levels because leverage is going up and down. So the idea that asset prices depend on leverage is very simple. If you imagine all the buyers in a vertical line from the people who like it the most to the people who like the asset the least, and and they differ in their valuations. Somebody, the marginal buyer, is going to think the asset price is fair, but the people who think the asset price, think the asset's worth more than that, the people above the marginal buyer, they're going to think, they're going to be buyers because they're going to think the asset's worth more, and the people below the marginal buyer are going to be sellers, and the marginal buyer, what he thinks is going to be equal to the price. Now, if leverage goes up, remember the buyers are buying everything the sellers below are selling. If leverage goes up, the buyers have access to more cash. They can buy more assets each. So you don't need as many of them to buy all the assets that are being sold. So the marginal buyer can rise because you need fewer buyers. But if the marginal buyer is higher, then the price is going to be higher because it's equal to the marginal buyer. It's as simple as that. So there are many reasons why people differ. Heterogeneity, is now becoming recognized in economics is very important. People differ in their risk aversion. People differ in how much they like living in houses. People differ in their optimism. Many reasons people get different, they can do something productive with some of the assets and others can't. Lots of reasons why people would have different opinions. So the leverage cycle amounts to this. If you have an asset priced here, and the normal borrowing, like on houses, is 80%, and somehow the world seems safer to lenders, they're going to let the borrowers borrow a higher percentage of the asset. And then the whole point is that's going to push the asset price up. But then it's going to make the economy more vulnerable because there's going to be so much more borrowing. It's a higher percentage of a higher number, a huge amount of borrowing. Now, just a little bit of bad news to the asset makes the asset go down, maybe below what's owed because it's such high loan to value. So who loses the most? Everybody's opinion's gone down because of a little bit of bad news, not down that much. But the people whose opinion matters the most, they were the ones who are leveraged the most. They're the biggest buyers, and as we saw from that earlier argument, they're going to be huge losers because they were so far leveraged. So you take out the biggest buyers, and all of a sudden the price is going to go down more. But then the most important thing is, if the news was scary, or just because the prices have started to go down, the market's going to get worried. And that uncertainty is going to cause them to demand lower loan to value, more collateral. So the new buyers won't be able to borrow as much money, and the price is going to go down much more. That's the leverage cycle. And the end of it is, you might be left with debts so much above the asset prices that they're impossible to pay, and the only way to intervene really is to just forgive some of the debt, because the lenders aren't going to get it anyway, and pretending that they're going to get it is just bad for everybody. So the central banks, therefore, should try and counteract this leverage cycle. They should restrain leverage when things are going up too fast, and they should step in to prop up leverage when it's collapsed at the bottom of the cycle. It's not the interest rate, it's leverage I'm talking about. So in the, okay, so there's some evidence of this. This is some data we kept at my hedge fund starting in the 1998 crisis. The blue line is the loan to value. You can see 100 there, so everything's just below 100. So the loan to value is we kept track of a sample of bonds that we were interested in. What was the loan to value we were being offered on the average for those bonds? And you see it was sort of 90%, and then it dropped to 60%. You know, that was the 98 crisis when long-term capital went out of business. A huge drop in the amount of leverage, what you could borrow to buy one of those bonds. And then the leverage after a few months went back. Everybody said that episode was crazy lenders who had no idea what they were doing. They just got nervous, and suddenly, you know, that's why we called Warren Buffett. It's so unfair. You know, they're changing the margins on us. So everyone thought it was crazy lenders. I was worried they weren't so crazy, but anyway, the leverage stayed pretty much the same at 90%, and then it went up to 95%. You see towards the end there, that's around 2004, 2005, 2006. It's 20-to-1 leverage. Okay, the red line is an index of bond prices, of the kind of bonds that we buy, not exactly the ones we had. You know, it's a JP Morgan index, so not exactly the same bonds but pretty close to the ones that we're looking at the leverage at. Okay, and so what you see is that suddenly the lenders get nervous and they start asking for more collateral. Leverage plummets. And at the same time, the prices plummet. You see they hit a low. They went from almost 100 all the way down to terrible levels, you know. 20, 30, this was subprime bonds, a huge collapse in these bonds. They were AAA to begin with, and they're completely collapsed in price. Now that was the diagram up until that point, which is 2008 or 9 there, with the bottom. That was the diagram I used to talk about when I went to the Fed in 2008 and 2009 and said, why aren't you keeping track of data like this? Now they do, but at the time they weren't. Okay? So now I just decided, even though that was when I was talking, the leverage cycle was at its heyday, I kept track of what happened to leverage and prices since then, and you see that they both went up together. So there's one evidence for the leverage cycle. Another one, is the famous Shiller Housing Index. So if you look at the green line, that's starting from 2000, it hits its peak at 2006 in October or something, goes up 90% housing prices from 2000 to 2006. Incredible, he called bubble, and then it crashes after that. And he said the story is irrational exuberance. There's a narrative that people think things are only going to go up, and they tell their friends to buy because things are going to go up. And one guy tells another guy who tells another guy, and the frenzy of the market makes things go up. And then someone one day says, you know, they can't go up forever. Maybe they're going to go down. And the narrative changes, and everyone said they're worried about going down, and they sell, and the prices go down. So I think there's a lot to the psychological theory of prices, but there's also something to collateral. So the purple is the loan to value of the non-government loans, which became 50% of the market, you know, in the heyday there. And so you can see it went from 14% down payment, 86% leverage, all the way up to 97.3%, 2.7% down payment. So from 7-to-1 leverage to 37-to-1 leverage. And at the very same month that the housing prices started to go down, leverage started to go down. So they went hand in hand. All right, so if you look at, this is by the Federal Reserve Bank of San Francisco, a different kind of leverage, but it's related to it. If you look at the debt to income of different countries, in 1997, the gray line, and in 2007, the red line, what you see is that in many countries, there was a tremendous shooting up of debt to income. You look at the Netherlands or the UK, or at the end there, Iceland. But in other countries, like Germany and Japan, in the middle, it didn't change at all. So what happened from 97 to 2007 to housing prices? Well, if you look at Ireland, that was the biggest one, and the UK and Denmark and Spain, Tano, you see this huge increase on the horizontal axis in leverage, or that ratio, debt to income, and on the vertical axis, the change in housing prices. The more leverage you were, the higher the housing price. Spain and Germany and Japan, no change practically in either one. If you look at who suffered in consumption the most after the crisis, it's Ireland and Denmark and Spain. They're the ones who suffered the most, and the ones who suffered the least are Germany and Japan. Okay, now I say that this theory has a lot of common sense to it. In fact, has been described in a way by people long before, and Shakespeare is the earliest and closest story I could come to. So The Merchant of Venice is usually thought of as a comedy and sometimes a commentary on anti-Semitism. And I think both of those are very important elements of the play, but really it's about the leverage cycle. So it opens with Antonio, the Merchant of Venice, showing up on stage, and someone says, "Oh, Antonio says, 'I know not why I'm so melancholy.' And the other guy says, 'Well, I know why. I mean, you've got all your boats, on the oceans, and I mean, anyone in your position would be scared to death. Of course, that's why you're so upset.' And Antonio says, 'No, every boat's on a different ocean. Not worried about those.' And then the guy says, 'Well, it must be, love. You're failing at love or something.' And Antonio says, 'That's not a problem at all.' So the very opening line of the story tells you that it's business first and love second. So it's really about leverage and not about love. And then, of course, the story is about Bassanio trying to woo the beautiful Portia, and he needs the money. He tries to borrow it from Antonio, doesn't have it because it's all on the oceans in his boats. And so they have to go to Shylock to borrow the money. Now, there's a long conversation about what the terms of the trade are, and I watched the play in New York with Al Pacino, and as I left the theater, I asked everybody I could see, "Do you remember the interest rate that Antonio and Shylock agreed on?" And not a single person could tell me what the interest rate was. But they all remembered the collateral, which is a pound of flesh. So obviously Shakespeare was trying to make the collateral was more important, so he made it more vivid. Now, the play, you suddenly get word that the boats apparently sank. You don't know that the boats sank. The boats haven't sunk. It's just there's a rumor the boats might have sunk. So the loan, by the way, from Shylock was 3,000 ducats for 3 months. So at that 3 months, Shylock wants his money back, and they can't roll over the loan because there's, everybody's scared the boats might have sunk. So no one will give another loan. They don't have the money to pay it back. So what are they going to do? Well, Portia shows up disguised as the judge, who she's already been wooed by Bassanio, who had the money and agreed to marry him, and she makes a beautiful speech about mercy and why don't you be merciful, Shylock, it's better for you, it'll be better for them too. They've even offered to pay back eventually 12,000 ducats. But Shylock says, no, a deal's a deal. We can't change the deal. All of Venice depends on enforcing the letter of the law. I always believe in the letter of the law. You can't change it. So anyway, she rules that it has to be changed. And how is it changed? What does she adjust? The interest rate, this or that? No, she adjusts the collateral. She said it should be a pound of flesh, but not a drop of blood. So the ruling authority intervenes to say the collateral was at the wrong level, and that's what needs to be adjusted, not the interest rate. And Bassanio goes up to her afterwards and says, oh, wise judge, he still doesn't know who it is, how can I reward you? And she says, well, how about giving me that ring? And he says, no, I can't do that. I just wooed and won my beautiful wife, and she gave me a ring, and I promised I'd never give it up. And the judge, who really is Portia, says, well, you asked me what you could do. I asked for the ring. If you can't give me the ring, then you really don't want to do what I asked. So he says, okay, I'll give you the ring. And so he then has to meet her, and she embarrasses him, but in the end, she forgives him because she knows if some circumstance arises that is so unexpected and so important, then you can't keep the letter of your promise. All right, so that summarizes pretty much my talk. Now, other people mentioned collateral before Bernanke and Gertler. So Bernanke, very importantly, the head of our Fed, and Kiyotaki and Moore came out the same time I did in Holmstrom and Tirole. But those people, at least at that point in their careers, they weren't worried about leverage changing. In fact, they weren't really worried about leverage. They were worried about collateral, but not about leverage so much or about it changing. There are many papers since then. But still, they don't, even in these more recent papers, they don't worry that much about leverage. It goes in the wrong direction. When things are getting bad, leverage is getting higher in most of these papers. So the punchline of the leverage cycle is that you should empower the central banks to regulate leverage and not just interest rates. Endogenous leverage should be put into macro models, and we have to destigmatize default and forgiveness. But I want to elaborate this in a more mathematical way, and I think it won't be so difficult to explain the mathematics to you because I won't really explain it to you. But I think by hearing what the theory looks like, I think it'll give it a better texture, and you'll also get an idea, some of you already know what mathematical economists do. So my starting point was the Arrow-Debreu model of trade. You have utilities, UH, and so a person is characterized by what he owns of all the different goods and what he wants. The utility, what he wants, and what he owns. And then they trade amongst each other. And Arrow's theory, the most beautiful, most important theory in economics, predicts what's going to happen. Now, he elaborated the theory by saying, you can have a future. Instead of trading things today, you could imagine different things that could happen in the world, different states of the world, different states of nature. A word that, the state approach was also one of the things he pioneered. So now you could have uncertainty, and the same mathematics can be applied to this case, provided you make the assumption that at time zero, you trade not only goods at time zero, but also promises for every possible good in the future, Arrow-Debreu contingent commodities, and nobody ever defaults. There's complete trust. So if you assume complete trust, the old model that he described applies to this new case. And again, it's a beautiful, elegant model explaining uncertainty and how people cope with uncertainty. Now, so I put an S for the states of the world to elaborate the model. Now, a friend of Ken's named Roy Radner said, well, there are too many states and commodities. It's unbelievable that you trade all those things. So let's just fix a set of promises, AJ. So there are different promises, AJ, and that's all the promises you can trade about the future. And again, we'll imagine that there's no default. So that was the next model, and most of finance can be fit into that framework. So I, as I said, started in '97 and ultimately ended up working with Bill Zame and others, made a model of general equilibrium with collateral. So what would you have to do to that? The promises AJ that you see over there have to be coupled with how much collateral you put up for that promise, and also with durability, FS. You didn't have to worry about durability in the Arrow-Debreu model. When you have collateral, nobody's going to think a house is good collateral unless they expect it to be around next year. So you need this sense of durability. So the contract, it's now not just a promise, it's a contract with a promise and a collateral that's going to sell for a price, which is how much you get to borrow by making the promise AJ, putting up the collateral CJ as collateral. And the delivery you're going to make in any state S is the minimum of the value of the promise and the value of what the collateral has become in that state S. So if the collateral is worth less than the promise, the borrower will just walk away and say, take my house. If the house is worth much more, the borrower will pay off the promise, maybe by selling the house. So that's the simple version of default and collateral. There's no trust. Nobody pays anything beyond the value of the collateral. There's not a single honest person in the world. The only reason they can be counted on to deliver anything is because they've put up some collateral. But this theory of collateral is quite different, simple as it is, different from the ones all those other people like Bernanke had described. They described what I would call corporate finance leverage. They worried that the value of the collateral might depend on how much you borrowed. The more you borrowed, the more chance you have to steal the money or to do other mismanage the firm because you'll be distracted with all that cash. Here, I'm assuming that the value of the collateral has nothing to do with how much you borrow or who you are. There are no collateral management problems. So it's the simplest, starkest case of collateral. Okay, so let's continue with the theory now that I have that theory. My first question was, if you think leverage and interest are two important variables, how can supply equals demand, that's one equation, determine both the interest rate and the amount of leverage? And I just racked my mind about that for a while, and then I realized, well, the whole point of the theory is that they don't have to, because for every promise, you could imagine different levels of collateral. Put another way, for the same collateral, you could have different promises. So you could take AJ and CJ, where all the AJs were just a multiple of the same promise. I promise $100,000, I promise $120,000, I promise $130,000 or $300,000. They're any possible promise with the same collateral. Okay, and each of those contracts in the theory is a different contract and will trade in equilibrium at a different price, pi j. So the price will change depending on how big the loan is relative to the collateral. So pi j is the price of the promise in the market. That's how much you get to borrow. P is the value of the collateral. That ratio is the loan to value. And the interest rate is just j over pi j. Okay, so you can write what I call the credit surface. On the horizontal axis, you look at every possible contract. So the bigger the promise, the higher the loan to value. On the vertical axis, what's the interest rate that the lenders will demand? Well, if there's very low loan to value, the collateral is so big compared to the loan, everybody feels safe. So they're going to ask for the same interest rate. But there's going to come a point A beyond which the lenders are going to start to get nervous. And they're going to say, gosh, there may be a default here. Maybe the collateral won't cover the loan in some state. And the interest rate's going to start to go up. I call that the credit surface. And this credit surface contains the answer to the question, what is tight credit? Tight credit isn't the interest rate 1 plus R, the riskless interest rate. Tight credit is, how soon does it happen that the thing steepens? And how steeply does it go up? That's what tight credit means. It means that for people who want to be a little adventurous and borrow a little bit more, how much extra interest do they have to pay? That's what I think captures what's going on in the economy. A tight credit surface or a low point at which the interest rate starts to go up. So this is not the standard thing that you see, or maybe it'll become and is becoming, but certainly wasn't for years a standard thing in macroeconomics. But that doesn't mean it's standard for business people. Everybody in business thinks about this. So when you try to borrow, you have a thing called your credit score, your FICO score, and a corporation has a credit score as well. So I went and I got a graduate student to look at all the loans given by Fannie Mae and Freddie Mac in 2013. Now in this diagram, you see the FICO score. 800 is pretty close to the top FICO score. It's like an SAT almost. That's on that axis. And on the other axis is LTV. So at the bottom there, in this near corner, you've got a low LTV, 60, and a very high credit score. This is a very reliable borrower, and that borrower pays a very low interest rate. But as the LTV goes up, you can see that the interest rate goes up. As the FICO gets worse, the interest rate goes up. So these are the most homogeneous buyers. I mean, in a way, they're all qualified buyers who have been selected by Fannie and Freddie and have all the right documentation and stuff, and still the interest rate depends on their FICO and LTV. Okay, so there are credit surfaces for mortgages, for car loans. There could be a credit surface for each one of these things. Here's Lending Club, the only other place I could get data so easily. And this diagram shows on the one axis, it's FICO again, as before. On the other axis is income. So you see as the FICO gets worse, the interest rate gets much higher. It goes up to 20% now. Lending Club is this online thing where you can, online people ask for loans and other people make loans and they publish all their data because they're trying to encourage the market and they've got the whole history of the market. So anyway, that's the credit surface. Now, why is the credit surface so important? Well, we can see, among other things, how it changes. This is the first half of 2012. Here's the second half of 2012. Here's the first half of 2013. Here's the second half of 2013. 14 and the second half of 14. So you see a dramatic flattening of the credit surface. It got much looser. So why is it that the American economy picked up in the last 3 or 4 years? I think part of the reason is that these kinds of measures will show that credit got easier than it had been before. That's part of the thing driving the American economy, which is missed entirely if you look at just the interest rate, which basically didn't change that whole time. So that's what I'm trying to get at. So I would recommend that the Fed, I've tried to tell them to do it, and the Office of Financial Research, they should produce this credit surface for all the big asset classes quarterly and publish it. We'd know so much better about what was going on in the economy if they did. And secondly, they should actually couch their analysis in terms of what they're going to do to the credit surface. So did the Fed anticipate that by buying mortgages, they weren't going to change the mortgage credit surface much, but they were going to change the corporate bond credit surface? And lastly, I think they should intervene in the credit surface. Okay, now I want to continue quickly with the theory. So it looks very complicated, all these different markets. A different loan has a different interest rate. You've got to solve so many different markets. But in the binomial case, it turns out that everybody choose, so different people could choose different points on this credit surface. Some might be more adventurous and pay a higher interest rate, some less. But in the case when only 2 possible states of the world, everybody miraculously will pick the point A. Okay, so I don't have time to explain. So the theorem I proved with my student Anna Fostel, who's now at Virginia professor. I don't have time to explain why. I call it the binomial max-min theorem. It says if you've got only 2 states where the collateral pays off a good dividend in the upstate and a bad one in the downstate, and the collateral's not like a house, it's like a share of a stock, a Lucas tree it's called, so it doesn't give you utility for holding it now, then on any family of potential promises, the only one chosen will be the max-min promise, the maximum loan that doesn't involve default. Okay, so that makes it very easy just to go to the point A and figure out how to solve the model. And it also explains what is driving leverage. It's where the point A is. The point A is going to be more to the left if there's more volatility. If the downstate is bad, you can't borrow much before you run the risk of default. So if the 2 states up and down are pretty close together, then you'll be able to borrow a lot more money before you run the risk of default, and A will be much more to the right. So leverage depends on volatility. Okay, that was the first part of the leverage cycle. Leverage depends on volatility. Here's a case where you can explicitly prove that. So you can also prove in a bunch of models that leverage makes asset prices higher than you would have without leverage. Okay, so if there are 2 assets, X and Y, and you can leverage X, but you can't leverage Y, and you can invest X and produce Y, then you can consider 2 economies, an N economy with no ability to promise, or a leverage economy. And it will always turn out in the simple 2-state and 2-good market that the leverage price of the asset is always higher than the non-leverage price. But then the surprise is that you can look at the Arrow-Debreu economy. The Arrow-Debreu economy, remember I described it earlier, that's the one where you can make any promise. There's complete trust. It's the most efficient possible world. Nobody will default, but they can always promise something and people will believe them. You could borrow even more. In the leverage economy, everybody's borrowing to invest in Y. So common sensically, you would think if you make it easier to borrow, you have an Arrow-Debreu economy, there's going to be more borrowing and more investment in Y. But no, it turns out that in a robust set of cases, the leverage is price of Y and investment in Y is higher than in the Arrow-Debreu level. Again, that's something I did with Anna Fostel. So it's a paradox. More borrowing, more access to borrowing, and Y, there's less investment in Y. Now, these other people who talked about collateral, they emphasized the collateral, constraining people not to borrow enough or to invest enough. And here we have the opposite, where you can have too much borrowing and too much investment. So what's the explanation? The explanation is collateral value. If you want to borrow, the only way to borrow is to have the house. So if you want to own something and borrow at the same time, you can only do it by having a house. That gives housing an extra benefit. It enables you to borrow, not just live in it. And if you want to bet on something, you can, by buying the house and selling a promise, you've leveraged your bet. You've multiplied it by 5. So the best way to bet is through the house. You couldn't bet in such a big way in any other way but owning the house. In the Arrow DeBrew world, where you can do anything you want without any collateral, there's no reason to need a house in order to borrow. There's no reason to need a house in order to bet. So the fact that housing provides these other services is what makes it potentially have an even higher, inefficiently high price. Okay, and if you look at the two things in America that it's easiest to borrow on now, it's housing and education, and both of those things have had skyrocketing prices, probably higher than they should be in the Arrow Best world. Okay, so I could describe now the leverage cycle, which unfortunately I'm not going to have time to do, which is you can have a multi-period model where the asset Y can pay 1 in all the stakes except down, 2 downs, in which case it only pays 0.2. And people can differ in their probability of up. The high H is a probability of up. Household H, that's Arrow's notation for a household. Household H is the probability also that household H thinks you're going to go up. So the high H's are optimists. They think things are always going to go up. The low H's think things are going to go down. And so the high H's are willing to pay much more for Y. They have the choice of X, which pays 1 for sure at the end, or Y. What's going to happen? Well, what happens in this model is, okay, you could look at it this way. The question is, what's the price at time 0 and what's the price at D? At U, when there's only a 1-1 that can happen, everyone agrees the price should be 1 of Y. What's the price going to be at 0 and at D? Now, most people you take, like Mr. 0.9, he thinks there's a 10% chance of going down, another 10% chance of going down, so only a 1% chance of hitting the very bottom. So he thinks the thing is worth about 99. If it goes down, though, he still thinks the thing is worth 92 or so. So he only thinks the price went down about 7 from going to 0 to D. But what happens in this equilibrium? The price starts at 95 and drops to 69. The calamity hasn't happened yet at 0.2, and yet there's already a crash in the market. Nobody in the whole economy thinks the price should have dropped down 26 points. Why did it go down so much? Well, it went down so much. It went down so much because at the beginning, at time 0, the top 13% of guys, 87 and up, by being able to borrow so much, they managed to buy all the assets, and the marginal buyer was a very high guy. But then in the down state, the marginal buyers, the biggest optimists, they lost a lot of money and went bankrupt. They were no longer able to buy. The remaining people who could buy, the remaining buyers, who now had to buy Y, they couldn't borrow as much because borrowing went way down. So the marginal buyer went all the way from 87 to 61. So the main reason for the drop in price is not that 87 changed his mind about what it was worth, it's just that the price is now being determined by 61 instead of 87. Okay, so you put together the 3 things I said before. The bad news makes everybody thinks it's worth less, but the increase in volatility makes leverage go way down, and so the new leverage buyers can't buy as much. Okay, and the marginal buyer has to go way down. So the price started much higher than the Arrow DeBrew price and crashed to much lower because of this change in leverage. Okay, and all right, so bigger than anybody thought. And the credit surface you could look at 0 and at D. It got much steeper and much tighter because now there was much more volatility at the bottom. So just to move on now to Greece, I think. Okay, so you could tell this, okay, so this is different from the usual, anyway, collateral story because leverage is changing. That's the crucial part of it. So let me move on to end with Greece. You could now describe this whole thing skipping all this, you could add some characters, as I have with a student, Yaniv Ben-Ami. You could tell this whole story by adding some more characters. So make it a sovereign banking corporate crisis, which is we call doom triangles. The doom loops had been invented by someone else. So we went one better and called it doom triangles. So basically, you've got a bank that's lending to entrepreneurs who are producing, and there's also the government involved. So what's the doom triangle? Well, if when things go down, it looks like the corporate loans are going to default, that means the bankers who own the loans have lost a lot of money. It also means that the government is not going to be able to raise as much taxes, so the government bonds are now going to go down, and so the banks are hurting, the corporate guys are hurting, and the government's hurting. So the government's not going to do its infrastructure investments, the banks aren't going to be able to lend to the corporate guys, and you have a whole mess. So it's the doom triangle. Everyone's affecting everybody else. The producers can't pay as many taxes, the government can't do as much infrastructure, the banks can't make loans to either guys, they're losing money because the other two guys are failing. Okay, and the crisis happens at D, even though productivity doesn't really collapse till DD. So again, the same story. All right, so where does this leave us with forgiveness? I'm going to close with this. So in all these crises, you find huge debt and little capacity to pay the debt, but the lenders are just determined to get their pound of flesh. So in the 2007 crisis in subprime mortgages, what basically happened? If you take a typical 160,000 subprime loan, let's say the house fell in value to 100,000, and you forced foreclosure on the borrower, threw him out of his house. You didn't get $100,000 back because he didn't get thrown out for 2 or 3 years, during which he didn't pay his mortgage, he didn't pay his taxes, he didn't fix the house, he stole the copper on the way out. So you didn't, on average, these subprime loans, and there was $500 billion of losses in them, on average in these subprime loans, the recovery was less than 25%. You got 40,000 out of the 160 back. Had you forgiven 160 down to 90, the homeowner would have gracefully sold the house himself to pay you the 90 and kept 10, or maybe just paid the 90 because he really had it. So everybody lost by not paying down the debt. Instead, okay, so what I proposed was that we have a bunch of servicers appointed by the government who went to every house subprime homeowner and said, what change can we make in the loan to get the lender the most money? And most of the time that would have been forgiving part of the loan, I felt. Instead, the Obama administration temporarily reduced interest rates, and here you look at the redefault rates. So once the interest rates went down, people paid for a while, but by 18 months afterwards, 70 or 60% of them were redefaulting anyway, because they were still so far underwater. So, okay, and the rate of people defaulting was astronomical, 5 or 6% a month. So anyway, that's the talk I basically gave in Greece, and then the Greek prime minister asked to hire me, and so just in 2 minutes I'll summarize the Greek situation, and Joe's an expert on this, but so Joe was advising the previous government. But anyway, so I show up, not really knowing what's going on, and I realized that what had happened is the year before, Greece had agreed, they had this dramatic vote, the ohi vote, the yes-no vote, where they were going to defy the EU or else agree to their terms. And the polls all said they were going to agree to the terms, just like in this last election in America, but 69% voted to defy the EU. But then when they went to defy the EU said, well, leave. And they decided they couldn't leave, and so they ended up being forced to accept an even worse deal than they had before. And the worst deal was pay 3.5% of GDP basically for 30 years. Now, no country ever has paid 3.5% of GDP. The greatest generation in America that fought World War II and then paid down the huge debt only paid 3.5% of GDP twice in those 30 years. It took 30 years to pay it down. So the IMF, which had been very tough on Greece until then, even they recommended only 1.5%. So there was this standoff between the IMF and the EU, and nothing could happen, and that's where I came in. So the EU has lots of reasons not to want to forgive the debt. If they forgave 200 billion of the $300 billion euro bet, they'd have to raise the money to recapitalize the central bank of Europe. With the debt forgiven, Germany's worried that Greece might borrow again. They like that there's a high debt, so Greece is stuck, not being able to get themselves in more trouble. Other countries might demand forgiveness. You know, it's Germany and the rest of Europe are still giving Greece more loans now to pay off the old loans. It's embarrassing to tell the people of Germany that, well, they couldn't pay the old loans, but we're giving them new ones. So they've got lots of reasons why they don't want to default. So what should Greece, well, what did they end up doing? So I was a complete failure. What they did is they decided that they were going to just postpone the 3.5% till 2018, lend Greece a little money to get to 2018, and then renegotiate in 2018. Now, what did I recommend? I want to end with my proposal, just so that maybe I can interest Joe or someone else who's going to advise Greece next time. I proposed two things with Jeremy Bulow, who was my college roommate and who I got roped into this. We proposed that you can't agree on 3.5% or 1.5%. Make it a contingent thing. Make the debt payment, the percentage, depend on unemployment. If unemployment's 24%, like it is now, Greece shouldn't pay anything. As unemployment goes down, maybe it can go up to 1.5%. If unemployment goes down to 3%, like it was in America after World War II, then maybe you can pay 3.5%. So agree on a schedule if you can't agree on a single number. So I thought that was common sense, but didn't get very far. And then our second proposal was, how can we get Greece to believe that it's been forgiven, 2/3 of the debt, which means it'll have the incentive to pay the other third, which is good for Germany too, but at the same time convince the Germans they don't have to make all these big payments and forgiving things and recapitalize banks. So how can you make the Greeks believe it's been forgiven and the Germans think it's not forgiven? So our proposal was, every time Greece pays back a euro, Germany then forgives 2 more euros. So of course the Greeks are going to immediately say they forgave 2/3 of our debt. But the Germans, they don't have to do anything until Greece pays. Greece hasn't paid anything. So Germany and Greece will pay very slowly. So the debt, the German raising the money needs to happen very slowly, and Greece is still in a huge amount of debt and so can't go off and recklessly borrow somewhere else. Anyway, that was our proposal, and it didn't get anywhere. So that's where I'm going to end. Thank you.
So thank you very much. We convene once a year to honor Arrow's work and celebrate his many contributions to economics. When I was a first-year student at the University of Chicago, I would go to Jose Schenkman's office on a regular basis to talk. He would eventually become my advisor together with Mike Woodford, who's here today, and Lars Hansen. And I would go regularly to his office, and he would say, oh, you should go and read this paper by Arrow. Then I would go again, and he says, oh, you should read this other paper by Arrow. So eventually I ended up buying, this Harvard University Press collected works by Arrow. And of course, when I read it, like many people in this room, as an economist, you're transformed when you read the breadth and scope of Ken Arrow's work. So this is also a fun occasion for me to discuss John's work. As he said, we meet on a regular basis in the advisory board at the New York Fed, and we have a bit of fun together, being mischievous to the extent that we can. But also because his work had a big influence on me when I was writing my dissertation, and I'll tell you exactly where. And my first published paper is actually a direct descendant on some of his work. So what I want to do is describe a little bit of the theory and tell you a little bit of how I think about this, make some connections with other fields that I'm interested in particular asset pricing. And what I'm going to do is poke a little bit in some aspects of his work. And then, I also want to make Joe happy. So I want to reintroduce asymmetric information in this lecture because I think it's quite important. And I will end up with some comments on the data. And we'll leave it at that, and hopefully we'll have some time for comment on some of these things later. So this is the simplest version of the model. So think of the standard Arrow-de-Brue economy with 2 periods, 2 states of the world. You have some endowment. There's a stock that you have some endowment of. So think about that stock as having a positive net supply. And there's some debt that is in zero net supply that you can use to borrow and lend between the different agents in the economy. And these agents, these households, are essentially indexed by the probability of this high state of nature that the stock will deliver a high cash flow, okay? So the way to think about this is that you have an economy populated by agents with different beliefs about these different states of nature. They have some stock, they can borrow and lend from each other, but critically, debt has to be collateralized. So if you want to borrow, you have to post 1 unit of the asset and make a promise J, and the payoff associated with the debt is going to be the minimum of what the stock is and the promise you just made. So think about this situation as one where you can lever up, but debt has to be collateralized by your equity position on the underlying stock, and these promises are basically the minimum between the value of the collateral and the promise that you made J, which is kind of the nominal face value of the loan. So the agent will raise a certain amount, depending on how much of this debt it issues, the agent issues at a price pi J. That will be how much I'm leveraging up. And a collateral contract, think of it as being an interest rate that I will have to pay on this loan, plus a promise that I'm making, where the price of the loan is going to be determined by the usual expression. And as John very nicely put it, on this beautiful idea of his, that you can think about all these contracts being out there, and they get activated when people decide to actually, trade in one of these specific contracts, which means an interest rate and a promise. Okay? So I want to make some comments. So the first one, is that the price of the asset, and what I mean by the asset is the asset that is serving as collateral, is an increasing function of the promises made on account of the leverage that the agent will be able to take. Essentially, the more the asset is levered, the more it ends up in the hands of the most optimistic of the agents in the economy, which of course put a higher weight on the high payoff that the stock is going to deliver. So John has this sentence in 3 papers that I could count. There's something wrong with asset pricing, and having written many papers on asset pricing, of course, I took offense at that statement. But what he means by this, of course, is that there's a difference between what you can use as a collateral and what you cannot use as a collateral, and that is, of course, going to lead to failures of the law of one price. Now, I want to elaborate a little bit more on this framework on one aspect. So let me bring you back to the very simple expression of what the Arrow de Brue price of an Arrow security should be, which we have over there. The price of that Arrow de Brue security, QIJ, so you're in node I, that Arrow de Brue security pays tomorrow in node J, is the probability given by lambda plus a risk correction times the payoff, which is 1 unit of consumption. Okay, or the price is the expected discounted cash flow. Okay. Now, one of the interesting things about the asset pricing literature is that, to a large extent, everything that we've been doing in asset pricing is all about this risk correction. We're interested about this. We're interested about premium. And we work very hard about trying to understand risk prices by basically moving these risk corrections that are embedded in asset prices. But lambda and M cannot be separately identified. Okay, these prices are a convolution of these 2 things, and we have powerful results that essentially say there's no hope of disentangling lambda and M, essentially. John actually wants us to go the direction of thinking very seriously about lambda, and I'm going to basically say that this is exactly right. So what is wrong with asset pricing is not so much these violations of the law of one price, but rather that we've been looking at the wrong tree, and we should be doing a little bit more of what John wants us to do with these kind of beliefs and differences in beliefs. And I want to challenge you to think a little bit about this. So we have a lot of survey evidence in many of these different pricing cycles. So let me bring you to a particular survey. So bring your mind back to the early 2000s at the peak of the NASDAQ bubble, and ask individual investors holding stocks whether they expect high or low returns. Well, if you think, like most of the asset pricing literature does, that everything that you see in prices is something driven by these risk corrections, the answer would be that prices are high because investors require lower rates of return to hold those risky securities. If that's the case, they should be expecting low returns to be realized going forward. If instead you believe that what is driving is essentially because people expect high future cash flows, well, then now the answer that they actually give in this survey is that, the expected returns that I expect at the peak of the cycle are high, not low, begins to make much more sense. And it does indeed what people answer. Okay, so we should abandon this kind of emphasis we put on these risk corrections and start thinking about these beliefs and where do they come from, and I will have some comments to say about that. Now, the problem, in addition, is that one of the problems that we have in macroeconomics, John, is that, those some of these things that we've done by focusing on the discount rate, essentially this stochastic discount factor, is that it induces too much correlation between things. That's essentially, everything is modeled through the stochastic discount factor. So, that basically means that you're going to be moving the prices across these states. Anything that loads on those states will be moving as well. John wants us to think about shocks to beliefs that are kind of asset specific. That's a rich discussion that we could have over dinner and copious quantities of wine. But that essentially allows for a richer correlation structure. And of course, you have to ask yourself whether you would have too many degrees of freedom when nailing this. And here comes, so we're not home yet. And, because we need to answer a bunch of questions to see whether the mechanism that John is proposing is plausible. And of course, the critical question is what kind of cross-sectional dispersion of beliefs are consistent with asset price irregularities, whether in mortgages, in housing, in stock markets, and so on and so forth. Why do beliefs move, and how do they correlate with higher macroeconomic activity? That is not a trivial question. Nothing pins down these things. So there's some interesting work to, for people to understand through their Facebook pages whether beliefs are high. If I have friends who have experienced housing appreciation or some good stock market outcome and so on and so forth. Okay. Now, beliefs are attached to asset payoffs. And this is a little bit tricky because if the market says repo, where most of the collateral is treasuries, it's difficult to envision what is the dispersion of beliefs that one should expect given the nature of the collateral that we're talking about. I agree with John that if the collateral is some type of collateral mortgage obligation or something like this, mortgage obligation, then, I can see, okay? And finally, and most importantly, the idea the government put, that providing insurance, government puts a lower bound on the prices of collateralizable assets, which increases their collateral value and places more of the assets in the hands of the most optimistic of agents, which pushes prices up. And now we have a leverage cycle that is essentially induced by government intervention. So tracking down variation on the credibility of the government put in particular markets actually can be a source of leverage cycles. Here's this beautiful result, the binomial no-default theorem. And it's basically the statement that in equilibrium there's only one active contract, and that is the one where you basically promise the lowest possible realization of the underlying equity, underlying stock, and the rate is going to be the risk-free rate. Now, one of the things that I learned from John's work is precisely the role of default in completing markets. And I think this is what we're talking about when we talk about deleveraging Greece, deleveraging Spain, deleveraging households who are deep underwater. And I want to, before I forget, to make this point about debt overhang in Greece and also in Spain. One of the problems of having this debt overhang is that in an environment with labor mobility, debt overhang actually encourages people to move away, which only kind of makes these kind of loops in which these countries are in only worse, effectively. Okay, so debt overhangs has terrible implications for economic stability. Encouraging risk-taking behavior, that's one of the reasons why default is good. And most importantly, what happens when you have collateral poor economies? We need a theory of demand for collateral and portfolio distortions that are associated with the need to actually have the collateral in order to take on risk in a different market. And there's a literature right now on safe asset supply, which is all about this, about the ability of the economy to generate safe assets that can be posted at collateral and that can serve as means of transaction. So I don't know how I'm doing with time. I hope you're keeping track. Oh, very good, Joe. That's the way, it's my colleague. So very good. So one thing about leverage, I think John is spot on another thing, which is this issue of the leverage, what we call the, assets to equity, the leverage or the leverage ratio, some people. If you think about Kiyotaki and Moore is a theory of that constraint that, essentially how much you can borrow is the value of the asset side of your balance sheet with a particular haircut. Now, it's a model of debt and how asset appreciation, can make for a more debt capacity, but it's not a theory of the procyclicality of the leverage ratio, which is exactly what we see in the data as documented, for instance, by Adrian and Sheen's influential Journal of Financial Intermediation paper in 2010. Now, why is that? There are many theories to this, and we should distinguish between all of them. Hyun-Shin emphasizes regulatory changes, the adoption of the Basel regulations. Now, discount effects and haircuts is another possibility that, if I think John is very safe investment, perhaps I'm happy to extend a loan with him with a lower haircut. Warren Buffett has made a career of very low haircuts in the swap market. And in some joint work that Jose, Patrick Bolton, who is also here, and myself have, this issue of double marginalization, that, somehow, assets, trade at different prices in different markets, and that can induce changes in leverage. But I want to start talking about the issue of information, and I think we'll connect with some of Arrow's classic work. If I think about the role of collateral in the economy, and this is a little bit different from John's work, in John's work, because loans are non-recourse, there's no point in collecting information about the borrower. Okay, so there are many good things about John's work in this aspect, but banks collecting information about you when you're asking for a mortgage is not something that is going to happen. Okay. Now, the way I think about collateral, I wrote a paper with Jose Schenkman on this, is essentially collateral as a substitute for costly information processing. Okay. So if you think about the world we live in today, where dealers, financial market participants have an enormous multiplicity of counterparties, think about keeping track of the risk profile of all these agents in the economy, okay? And I'm going to basically be talking to John, to Ken, to Joe, and so on and so forth, and I have to keep track of their risk profile and basically make sure that I'm extending the right credit for the right price, and so on and so forth. Now, this is informationally incredibly demanding. Now, one way I can solve this problem is, well, forget about that. I'm going to ask these guys to basically post collateral so I don't have to think about the credit quality. I don't have to think about other contracts that they're taking that I cannot monitor. This, of course, is an idea that goes back to some of the papers that Joe has on insurance as well. Okay? The lack of exclusivity, one way I can solve the endogenous changes on the risk profile of my counterparty is just basically by demanding collateral. But then what arises is the theory of too much collateral in the economy. Okay, there's too much collateral that the agents have to post. We're going to have too many of these crises when the collateral cannot be made readily available for a party that is having some idiosyncratic shock, and we can start these kind of big pricing cycles simply because everybody is demanding too much collateral in order to substitute for information collection. And by the way, this point is in a very nice paper in 2001 from the BIS, making some of these points. Now, I want to close with a couple of points about the data. About this issue of the collateral again. And let me tell you a kind of a story that I think will add some color to some of the things that John was saying before. One of the things that we saw during the years leading up to the Great Recession is that lenders were extending essentially first and second lien mortgages to homeowners. Okay? Now, one of the things that was happening, and there's a very nice paper in the Journal of Finance last year by my colleague Tomasz Piłsudski, is that lenders would essentially sell the first loan without revealing the existence of the second lien mortgage, which would be kept in the bank's books. So essentially, I'm selling this mortgage to John. John thinks that the homeowner has more equity than he really has, but the homeowner doesn't have that much equity because he has another loan that I don't get to see, essentially. So John is basically pricing the collateral as if the homeowner had a 30% equity, but he only has a 1% equity, and it's simply the fact that he doesn't have the information on the second lien. Okay? But now, think about this. He's willing to pay a relatively high price for this loan because he thinks, well, if I'm the homeowner, I'm going to take good care of the house. I have a lot of equity. I have a lot of incentives to pay, and so on and so forth. So I'm making some money. The bank is making some money off John by selling that mortgage at a higher price than is warranted given the existence of the second lien mortgage. Okay? Now, is there some evidence of this? So here's some data that my colleague was kind enough to provide for me. And then you have the average loan-to-value, the average combined loan-to-value in red, and the housing price index. And as you can see, this is for non-agency mortgages for which there was substantial variation in the loan-to-value as well as the combined loan-to-value. And as you can see, basically, what is going on there is that at some point the loan-to-value stops growing. So kind of these mortgages look good according to this metric for these non-agency mortgages. But eventually, what is going on is that simply the combined loan-to-value keeps increasing, pushing prices up. Okay? But it speaks to this agency issue inside the bank and about the value of the collateral. Okay? The price of that first lien mortgage in the market is too high relative to what it should be. So it's probably not being priced, the second lien mortgage that is hidden in the bank's books. Let me close with a couple of comments which frame this as slightly different, more broadly. So I've been thinking a lot about these issues. I'm working on some of these issues myself right now, so the offer to discuss John's work was quite timely because I was reading a lot of his work already. And I'm thinking about this particular pattern. So here you have total debt by households divided by disposable income, that's the blue line. And then what you have at the bottom in red, you have household debt divided by essentially some metric of housing wealth, okay, real estate prices. And as you can see, something happens in the early 2000s, okay, that household debt to disposable income starts going up quite dramatically. This also happened in Spain, where we don't have as good data. And of course, when you would talk with central bankers about this, they would point to the red line. They say, look, if you look at the kind of equity the households have, it's quite good. The leverage is not going up. So it depends on what you divide these things by. But of course, what happens once the crisis comes, these powerful pricing effects that John is discussing kick in big time and result in an increase on the household debt to wealth ratio, and now they have to start deleveraging, so the household debt to disposable income, which remember is going down quite fast on account of unemployment, has to go down even faster, okay? Now, all this is very fun and well, but what we worry about is kind of the welfare effects of this type of regularities is quite striking. So here what I plotted, I used a survey of consumer finances data to actually look at debt to wealth by wealth percentile, essentially. So, and I basically fixed the 2009 wealth distribution and compare the debt to wealth across these different wealth levels. And as you can see, the debt to wealth was concentrated, as we know well, among those that were the less wealthy. What is striking is how skewed the distribution becomes in 2009. So the welfare effects associated with these kind of leverage cycles can be enormous on account of the very high marginality of consumption that we're going to have on the lower end of the wealth distribution, which only makes John's closing remarks about debt overhang and debt forgiveness and these schemes all the more important. Thank you very much. Thank you.
It's a pleasure to be here again to celebrate Keng's work. As many of you know, this particular paper picks up on one of Keng's most influential papers on the Arrow de Bruce securities, named after Arrow, obviously. And that was a description of what an economy in which there were a complete set of risk markets would look like, perfect asset markets in a sense. And that generated an enormous amount of work because it was so clear after that Ken recognized that there were not a full, complete set of risk markets. And beginning actually not long after his work, John referred to the work of Roy Ratner, began an exercise of trying to understand what worlds in which there was not a complete set of risk markets might look like. And that turned out to be extraordinarily fruitful. One strand of that work that links, I'll explain in a second how, that links with this paper is that of Modigliani and Miller, because they said that they were focusing more on corporate borrowing than borrowing to buy assets. But in my own work, I also focused really on not on financial markets separate, but looking at underlying financing, for instance, for investment. And the basic insight of the Modigliani-Miller theorem was that leverage didn't matter at all. That is to say, if you borrowed more, if a company borrowed more, its debt went up, but that it might look as if it was getting a good deal and getting higher return on the equity, but the equity risk was going up, and that was exactly described. The basic insight of the Modigliani-Miller theorem was that leverage didn't matter at all. And maybe when John comes back, he can explain why his model is different from that of Modigliani and Miller, which argued very strongly that it did. Now, as a young economist at MIT, I had not only did I benefit from all of Ken's papers, but I also benefited by being a student of Ken at MIT. In the mid-'60s, I wrote a paper about the Modigliani-Miller theorem with bankruptcy, and showing that the Modigliani-Miller theorem did not hold if there was bankruptcy. And so the issue of what happens with bankruptcy actually began very early after Ken's work. One of the other, once you recognize, once you start having the notion of bankruptcy, you recognize that the way securities are written are very different from the Arrow-Debreu securities world. The way securities are written, a debt contract is, I pay you a certain amount unless I can't. And the question, if I can't, there are certain conditions, then you go into bankruptcy. And if you go into bankruptcy, there may be some deadweight loss that John talked about. And the other party then seizes your assets. And whether you call that seizes the assets or gets the collateral, it doesn't make much difference from a general perspective. Jean talked a lot about collateral, where the value of the collateral doesn't vary with who controls it. And many of the issues are those where it actually does vary. I'll come back to that in a second. But once you recognize that the way the instrument, the way the financial is specified, you realize that actually there's this very important possibility that John highlighted, that the two sides of the contract may think the value of what is being exchanged is very different. That is to say that the borrower thinks that he is going to pay back more than the lender thinks that he's going to receive. And that, of course, is exactly the point that John talked about at the end. And it was a point that I highlighted in a paper that I wrote in 1972 about bankruptcy and default. Where that becomes very important in the context of macroeconomics is that is that when a firm goes into or a household goes into bankruptcy, or when the economy goes down, let me put it like that, and the probability of bankruptcy goes up, the borrower thinks that the likelihood that he'll be able to repay is much higher than the creditor thinks he's going to get back. That as the homeowners in the United States, many of them faced, were underwater. It was remarkable. Underwater meant they owed more money than the value of their house. And under non-recourse loans, they all should have defaulted. Most of them did not. And the net effect of all this was that the debtors all thought that they were honest people and were going to repay the loans. But the creditors weren't so sure. And that highlights a very important point that Martin Guzman and I have been working on, a notion of what we call pseudo-wealth. Namely, the aggregate wealth in the economy went down because there was wealth destruction in expected terms on the part of the creditor, and that was greater than the amount that the debtor thought that he was being relieved of. The debtor was relieved in the sense that he was not going to pay back. That's a general point. It's a general point because what we've highlighted is that, for instance, when there's an increase in betting opportunities and there are differences in beliefs, then one side bets with the other, both sides that are going to believe that they're going to win, the sum of what they each believe they have is greater than what the wealth has, the wealth in the economy is. But over the business cycle, the net value of this pseudo-wealth can vary a great deal. And that in the run-up to the Great Recession, people had a lot of pseudo-wealth. They all felt very wealthy. But when it crashed, there was more wealth destruction, there was pseudo-wealth destruction. And the work that Martin and I have done, we've shown that that can be part of an equilibrium process. So the point I want to make is that whenever there are differences in beliefs of the kind that John highlighted, there can be macroeconomic fluctuations, but they can be based on a number of different contexts. One of them is this increase or decreasing pseudo-wealth that can be amplified over the business cycle. There are two more preliminary remarks. I know I have to stop soon, but I want to make before coming to the policy implications, which I think are quite interesting. The first general observation is that in the Arrow-Debreu model, in a sense, debt, the fact that there is a given level of debt, shouldn't make any difference to whether there's unemployment. There should be full employment no matter what the level of debt is. All the debt is the fact that somebody owes money to somebody else. It affects the endowment. But at any level of endowments across the economy, there should be full employment. I mean, that's the nature of a competitive equilibrium. So the question is, there is a widespread belief, and I think some evidence, that debt does matter. But the level of indebtedness shouldn't matter because it is just a transfer of the ownership of wealth in the economy. So what I think my interpretation of what is going on here is that when you have a lot of volatility in perceived wealth, in the way that I just say, pseudo-wealth, in ownership claims, that has effects on aggregate demand, and that the ability of wages to adjust is not sufficiently great, wages and prices generally, to adjust to those changes in aggregate demand to restore the economy to full employment. So this is, in some sense, one part of the story of macroeconomic fluctuations, which is the fluctuations in the value of assets, the value of wealth, and the value of, implicitly, of aggregate demand. But it has to be accompanied by another aspect of the theory. What are the rigidities that impair the economy's full ability to adjust to those fluctuations in aggregate demand? The second general observation actually goes to work that John did with his colleague Paul Marcus back in 1986, and that I did parallel work that I did with Bruce Greenwald at the same time on macroeconomic externalities. Or on, let me put it like this, on pecuniary externalities, on the fact that when there are not a full set of Arrow-Debreu assets, and the work that Bruce and I did, when that was true, or there were imperfect asymmetric information, then in general, competitive equilibrium is not Pareto efficient. It's not constrained Pareto efficient. There has been recent work taking on that idea and extending it to macroeconomics and arguing that these kinds of inefficiencies manifest themselves in macroeconomic context, and in particular result in households, firms undertaking too much debt or leverage, so that the competitive equilibrium without government restraints may have excess debt, excess foreign denominated debt, and that brings me, and that's important because that links to John's key policy recommendations, and those entailed government, central bank, taking a more active intervention in the market. And that is to say, in standard monetary economics, the focus has always been on, or has been on the interest rate. It's not always been the case. There's a long line of monetary policy in the UK, for instance, based on the availability doctrine, that it's credit availability that matters. There's a line of work in economic theory, based on my work with Andy Weiss, that credit rationing is important and affects macroeconomic behavior and microeconomic behavior, and that central banks' behavior can affect the availability of credit. So while that line of work of credit availability has not been absorbed as much in the last 15, 20 years in modern macro, it was a standard part of traditional macroeconomics. I think the good news is that it's being brought back in, and John's first recommendation is empower central banks to regulate leverage, is now a standard part of what is called macroprudential regulation. Not only do they regulate leverage, they regulate things like loan to debt service to income ratios of what banks can do, because those variables can change. Those variables may be a more reliable indicator of people's capacity to repay than collateral, the value of which can fluctuate a great deal, as we just pointed out. So I think it is a good thing that I think that's a very strong recommendation that I think is being taken into account by at least many central banks, and some have already done this, like Korea, very strongly. The other recommendation that he put emphasis was to destigmatize default and debt forgiveness. And again, that's something that I very strongly supported. It was something that should have been done. There are a whole set of ways of debt restructuring that involve greater flexibility. In the case of Argentina, back in 2001, they introduced GDP-linked bonds. And those GDP-linked bonds have that same kind of flexibility. Those, unfortunately, go in the opposite direction of the kind that John talked about, where the receivers thought they were getting very little, and Argentina thought it was paying a lot. It turned out that Argentina was right, that Argentina did pay an enormous amount on these GDP-linked bonds. But I think the notion that John talked about at the very end is an important one, and actually has been some ideas that have been implemented in policies in some other context of thinking about instruments where the two sides think that different things are going on because they're based on different beliefs. There's been some carbon pricing initiatives that and safety valves that have that same kind of flavor to them in the case of carbon pricing, since those who are pessimistic and optimistic have different views about whether they'll be triggered. It turns out that you can get agreements on the acceptability of these ideas because the probabilities of the events are very different. So looking for ideas where you can get agreement by exploiting differences of views, I think is a very clever thing, and I hope that one of the governments in Europe, or the Troika, will take up your idea for a resolution of the Greek crisis.
I must say most of the points I was thinking of have already been discussed, and with the light here I can't read much what I'm reading, what I wrote down anyway. A few comments. The emphasis on the general equilibrium, why it's the Arrow economy fails here, of course, is obvious enough. It's a lack of information. We simply don't know. We don't have enough markets. It's impossible to have the markets because, for example, if you agree that you're going to pay so much in state S, both parties have to know that state S occurred. And as soon as you recognize that fact, you can't make contracts. You only make them on agreements where both sides are verified. And this is a basic consideration which has been implicit in most of the remarks made here. Let me make a few smaller observations, and I will speak briefly. One is that there seems to be a body of credit which is unacknowledged by anyone here, namely loans that are unsecured. There is a considerable volume of loans for which there is no collateral. Presumably they're safe, they're regarded, but there are loans of this kind, business loans, a lot of them. The question is, how do they, you might say, if you take the literal definition of a leverage, you get a negative number. That doesn't mean much of anything, but that's what the arithmetic would come out to be. And I just wonder to what extent this modifies the considerations here. Obviously, the basic point is, of John's argument, in terms of policy, apart from the forgiveness aspect, which is extremely important, is the idea that regulation of interest rates is only touching one aspect of the economy, that the basic things are that leverage ratios or something equivalent plays at least as big a role. Certainly, the discussion every few weeks of whether the Fed is going to raise its rate by 1/4% or 1/8%, it strikes me as being rather obviously somewhat ludicrous in terms of its potential effects on the economy. One thing is not clear to me, and perhaps John might address it, is to whether the fact that we're at what Keynes would call a liquidity trap is relevant here. Is this true at any level of interest rates, or is it only some special property of the present situation that the interest rates don't matter? I'm struck historically by the changes which I think Joe's alluded to, changes over the 50 or 75 years, let's say, in what constitutes Federal Reserve policy. If you go back to the post-war period, it was open market operations. You get money into the thing, which is, I guess, coming back is somewhat resembling quantitative easing. But that was the dominant feature of the thing. You get money into the economy. Somehow there was some vague argument. You get money into the economy by buying up these bonds, and then people respond to the increase in the money stock outside the government. And in a way, Friedman was very, obviously put the money stock first and foremost. In fact, that's remarkable for a person who presumably is advocating the price system as the solution to everything, didn't mention prices at all when it came to monetary control. He didn't discuss interest rates, and of course he didn't like any policy. I mean, that was quite explicit about that. It's not an implicit statement. He was quite explicit about it. But yeah, he was, at least in the early phases, arguing that you can get automatic stabilizers. Things so you'd raise the monetary stock by X% a year steadily. And never mind what the current economic situation is. And this would kind of straighten out by injecting the money into the economy this way. Interest rates played no role in this discussion. In fact, not even in this discussion of the consumption function. You find that most people would assume a theory of choice between savings and consumption might have something to do with the rate of return, one way or the other. It might work both, either way, but at least there would be some effect to the rate of return. There's zero effect. He never discusses it. He finally, at the end of the book, says, if you look at the behavior, it's as if the rate of return was something like 30%. In other words, that consumers were rationed, in effect, and not facing the market rate of interest at all. Well, I believe that as a historical rather than as a common remark. Now, one thing I don't think I've seen, really haven't seen explicitly is an analysis, let's say, of the leverage situation, taking account that both the probability default and the price, the value of the security of the collateral, the value of the collateral, are both uncertain. There's a risk-bearing element, which I think is not, I haven't seen explicitly addressed in this discussion so far, as to how this affects the equilibrium of the value. You talk about optimism and pessimism at the scale, but and particularly on the part of the lender, as well as the borrower. Well, I think I'll stop at that point, and I have nothing more to say. Thank you.
Ken, do you want to stay here? Yeah. Well, thank you very much. I'm been assigned the job of being a moderator and a little bit of a timekeeper, but I'm not very good at timekeeping. And David will intervene if I get too bad at this. John, did you want to have any comments now, or do you want me to take questions from the audience?
I can, you all asked me some questions, but I could answer them after even better questions.
Okay. That was.
Hi, can you hear me?
Yes.
Okay. Thank you for the opportunity to ask a question. My name is Ian Brinkley, and I work with the LaRouche Political Action Committee. I wanted to address two factors which I think most clearly illustrate the massive risk to the global economy, especially the U.S. economy right now. The first is the increase in the consumption of people who are sectors of the population which have no functional connection to the production of useful goods and services. And this is exemplified, I think, by the Wall Street speculation and the profits from that. Second of all, the decrease in total production per capita of useful physical goods and services. This has been happening for quite some time.
We
Yeah.
have a short time, so if you want to just make sure you have a brief question. Okay.
Right. Well, my question was that the sustaining factor behind this process has been one of primitive accumulation, as you see with the infrastructure deficit, about $5 trillion. Massive debt increases. We're closing in on $65 trillion in debt for the United States. Debt to GDP ratios are skyrocketing. And, of course, outright crime, as we've seen with Wells Fargo. So all this considered, Lyndon LaRouche has put forward a plan, which is 4 steps. The first one is Glass-Steagall.
I'm sorry, you have to just one sentence question.
Well,
That's it.
my question is, what do you think about this plan? And I can be very brief. The first was
Okay.
Glass-Steagall.
No,
The second is the establishment.
I'm sorry, it has to
of
be
an-
related to the paper. I'm sorry.
So even if the
that's-
economy is threatened with a major collapse, I mean, Thomas Hoeing is also saying that we're facing another banking crisis worse than 2008. We're trying to find a solution to that. You're not interested in this issue?
Sir, we need to give others a chance to make a question. Please.
I was wondering.
Isn't this supposed to be a meeting of economists discussing how to make the economy better, or?
Yes, but we need
No.
to give others a chance to speak.
Okay, fair enough. Well, I have some material for you to take when the session is over. Thank you so much.
So John, one of the interesting things that you stressed was the idea that policy, I guess particularly Fed policy, should focus on regulating leverage. And I was wondering if you could say more about how you imagine that happening. I guess in particular, if one wants to prevent leverage from becoming too high. I mean, the role of, insisting on minimum margin requirements, say, on lending against stock is something that the Fed can do and has done. But on the other side of the cycle, if the problem is that you go into a crisis phase where lenders are insisting on too much leverage, is that something that you imagine regulation being able to change that? I mean, can you force people to lend requiring less collateral than they're wanting, or what exactly do you have in mind there?
Okay. We're just gathering a few questions, and then John will ask. Or do you want to answer?
Yeah, Andrea has one.
You want to answer that one? Why don't you
Well,
answer?
why don't I just answer a couple of the things that have been asked so far, and ending with Michael's question. So Joe asked me what the connection was between what I did and Modigliani Miller. That was a very telling way of saying that the old style, finance macro, leverage made no difference at all. I mean, that's precisely what Modigliani Miller said. So what changed in Modigliani Miller? So needless to say, he didn't give the answer he himself knew, but he's left it to me. Probably the best exposition of Modigliani Miller is by Joe, maybe with a co-author, I've forgotten. And the gist is, suppose that a bank is issuing some riskless debt, and it's also got equity. And now the regulator, or some reason, the bank has to issue less riskless debt, and this equity then becomes safer. So how could that possibly not change the equilibrium or have an effect in the economy? For one thing, where's the riskless debt? There was somebody buying the riskless debt. The bank isn't issuing it. How could that not affect the economy? Well, as Joe explained, the point of Modigliani Miller is that a new guy comes along, the old equity buyer who's buying risky equity, it's now much safer. So what that guy does is he buys the safe equity that's now being issued by this regulated bank, but makes it look like the old risky equity by issuing debt of his own. So the debt that the bank reduced has been replaced by debt that a new guy creates, and that's the essence of the proof of the Modigliani-Miller theorem. That Modigliani-Miller did not say it nearly as clearly as Joe did, and that's just Joe's explanation. So what has this got to do with leverage and collateral? Well, the old bank maybe had a lot of collateral. They could issue a lot of riskless debt, and people would believe that they'd keep their promise. The new guy who issues the debt maybe doesn't have the collateral. There is no more collateral. It's all being held by the original issuer. So the new guy can't possibly issue make up for the lack of debt issued by issuing its own debt because it doesn't have the collateral. So as soon as you take into account the need to have collateral to back these promises, the theorem falls apart. So even though Modigliani-Miller purportedly is about default, leverage, and that increases the chances of default. It doesn't do very well when actually people are defaulting. So anyway, it doesn't take into account who's putting up the collateral, how do you know that they can keep their promise, et cetera. So that's in fact, the whole point of the leverage cycle is that, if you take the extreme where no one's to be trusted unless they have the collateral, then that's going to have a big effect. The way collateral looks is going to have a big effect on the economy. If there's one guy holding all the collateral and he stops issuing debt, that's going to change the amount of debt that can be issued in the economy because no one else can do it without the collateral. Okay, another comment that was made fairly often, which is very important, is that I was assuming incomplete markets. So it's exactly right. I was imagining a world where you couldn't insure everything. So because you can't insure everything, the volatility of prices going way up and then crashing way down, or investment going way up and crashing way down, without insurance, that's very costly for the economy, and people can't protect themselves against it. So for example, if housing prices, because they can be leveraged at some times and the price goes way up and at other times they can't and the price goes way down, that makes people who hold housing, they've got a riskier asset now. And so they can't do anything about it to insure themselves because I'm assuming there are no insurance contracts, or at least no insurance contracts without collateralized insurance contracts. So it's absolutely correct that the lack of insurance contracts, the fact that we don't live in the Arrow de Brue world, is what makes leverage depending on collateral such a important and worrisome thing. So that brings me to Michael's question, which is, so if it's true that in a boom, the lenders aren't worried, it's so easy to borrow, and that pushes the prices of things up way higher than they would be in the Arrow de Brue perfect world, and then in the crash, all of a sudden nobody can borrow and things are way lower, how should the Fed intervene in the crash stage? It can't regulate to make people lend at less collateral. They're too scared to do it. So what should the Fed do? Well, I think it's not at that point a matter of regulation. It's a matter of action. So what the Fed has to do, or what I think it should do in some cases, is lend itself like it did in the crisis of 2009. There are all these programs called TALF and things like that. And the student loan market, the car borrowing market, and the car borrowing, student loan, and credit card markets were all collapsing in 2009. And the securitization of those loans, nobody was able to borrow them. And no one could borrow to buy them because they couldn't borrow to buy them. And so the Fed stepped in and said, this is the Fed, our Fed. It stepped in and said, we will lend 95 cents on the dollar for anyone who wants to buy a student loan security or a car loan pool of securities, or whatever the third category was, student loan, car loans, credit card security. 95 cents on the dollar. The market wasn't willing to do anything like that. And so the Fed was confident that if it systematically did this and propped up the market, people wouldn't actually default on those things, which they didn't, and so it didn't lose any money. But it ran a risk of losing money, and the Fed had to be backed by the Treasury. So the Treasury wrote a check before they did that saying, we'll cover the losses if you face them. So that is action that's beyond regulation. It's a little daring to suggest such action, but after the crisis, Dodd-Frank made it tougher for the Fed to do a lot of things, like to bail out a single bank or something. You can't just go in and say, oh, Bear Stearns, we'll lend you a bunch of money. Can't do that anymore after Dodd-Frank. But what you can do is the very thing that we were describing. If the Fed decides to organize some market and lend at less collateral than the market wants, the Fed now has the power to do that. So they don't want to do that. I remember I was on a panel, but they can do that, and I think maybe sometimes they should. I was in a panel with Trichet and Bernanke, and I was doing my usual leverage thing. And so Trichet said, oh, this leverage, it's very important, but really, the Fed should, the central bank, he was the president of the ECB, the central bank could concentrate on interest. Let some macroprudential regulator worry about leverage. And I said, that reminds me of the old Soviet Union, where one bureau is in charge of prices and the other bureau is in charge of quantities. And don't you think that it should be in the same bureau? And Bernanke said that the Fed wasn't quite ready to act so boldly yet, but that it was going to eventually get there. And as Joe said, they've come a long way in the last 4 years since then. There are all kinds of leverage regulations that they didn't have before that they have now. I guess the last thing I should say is that I talked a lot about differences of opinion. I had to have heterogeneity. So I had to have it either that some people were more risk tolerant, that's why they were willing to buy the assets than others, or that they wanted to live in the houses more than the others, or that they just had different beliefs about what was going to happen. I had to have some source of heterogeneity. When I wrote my paper in the early, 2000, heterogeneity was sort of, differences in beliefs was a taboo thing. So I thought to myself, if I'm doing all these taboo things talking about collateral, why not go all the way and make the heterogeneity differences in belief? That'll attract more attention. And sure enough, although no one paid any attention to it actually until Michael rescued it, it has in its reincarnation attracted attention partly because I had differences in beliefs. But that isn't really the key to the model at all. It's just any kind of heterogeneity that makes some people more willing to buy the stuff than other people. And the people more willing to buy it will leverage, not because they think the world's rosier, but because they want the stuff more, and the only way to get at it is to borrow more to get it. So it doesn't depend entirely on heterogeneous beliefs. It just depends on heterogeneity. But I do think heterogeneous beliefs is important, and Joe's and Tano's have worked on this, and I'm glad to see so many people working on it. But, okay, so.
Okay. To Professor Stiglitz, you made the comment that regardless of the level of debt, there should be full unemployment. I'd be interested in whether you have a program for reassuring that. And secondly, the second part of the question is President Trump has stated that he's going to put back the 21st century Glass-Steagall. General question is, what effect would that have on these issues that you've brought up? A number of you have brought up, i.e. leverage and debt and employment and so forth.
Okay, why don't we take a couple, the last question, yeah.
Okay. The question is about forgiveness and this quality of mercy. Who is going to pay for that? Because if some people are speculating and getting profit, and do you think, and are you proposing that other people should pay for it? And secondly, about robotics, have you factored this thing that robots may create a lot of unemployment in the work that you are doing?
There's one more.
Yeah, Andre, you wanted to ask a question?
Yeah, go ahead.
Sorry, it's a technical comments on your surface. So first of all, anyone who has been working empirically on credit knows that it's very important. That it's there, it's very important, and but from the policy point of view, what does it imply in terms of regulation, in terms of monetary policy? Can you elaborate a little bit on this?
Okay, so I'll leave Glass-Steagall to you, Joe. But on on the quality of mercy question, who, if you forgive the debt, then does that mean the lender? Who bears the brunt of it? The point of debt forgiveness, Portia's point, is that you make the lender and the borrower better off. It's not that someone is. The point is the lender's not going to get the money back anyway. When the subprime foreclosures hit and the debt was $160,000, the house was worth $100,000, they ended up recovering $40,000. And we had, it wasn't totally negligible, $500 billion worth of these houses going under and foreclosing. So it's not just a small sample, it's a huge sample. We know what happened in all those cases. The recovery was terrible. So knowing that the recovery is going to be so terrible, wouldn't it be better to forgive part of the debt in order to get the remainder back? So you forgive 160 to 90, you actually get the 90 instead of not forgiving it and ending up with 40. So the lender does better by forgiving, and the borrower, of course, does better when some of it's forgiven. I only think the easiest case to advocate forgiveness is when it's going to help both people, and that's what Portia was trying to say. And so in the subprime case, I was advocating, Susan Cognac and I advocated forgiving the debt of people who hadn't defaulted yet. You don't go to people who are stopping paying already. You go to people who are so far underwater that you know they're going to eventually default, and you forgive their debt. Okay, and that way, they haven't done anything wrong. There's no moral hazard you're creating. You are getting ahead of the situation and forgiving something that wasn't going to end up being paid anyway. Now, of course, in some of those cases, the people would have kept on paying, and there might have been a loss. But most of those people that far underwater did end up defaulting. And so, so I'm talking about people who have subprime loans, who have terrible credit ratings, who have nothing to lose in their credit rating by defaulting, who are underwater, far underwater. Those are the people whose loans I would have forgiven. And in the Greek case, even the Germans think they're not going to get the money back out of Greece. It's impossible that they're going to get all that money back. They just want to make sure they don't lose more money. If they're afraid if they forgive the debt right now, Greece will borrow more money, they'll get into more trouble, and Germany will rescue Greece again. I gave a bunch of reasons why they don't want to forgive. It's not because they think forgiving is going to lose them money directly. They're not going to get all the money back anyway. That's the case for forgiving, when you help the lender and the borrower. And now the question about the credit surface and policy. So it's a radical policy I'm recommending. I think the credit surface describes the state of credit in the economy very clearly. It would make lots of businesses understand what was going on in the economy if the Fed was publishing these, or the Office of Financial Research was publishing these credit surfaces. Everybody would know what was happening. They'd know that even though the interest rates are so low, it's not because nobody can think of anything to do at low interest rates. It's because the borrowers who do want to do something have to pay a much higher interest rate because they don't have the collateral or they don't have a good credit score. So that's what's stymieing investment. It's that the interest rate is higher than the adventurous borrowers are willing to pay. So you would see that if you saw the credit surface. So the first thing is I just want the data out there so we can understand what's going on. The second thing is when the Fed, it's not that, it's not that the Fed doesn't understand these things. They know that there's, credit spreads and adventurous borrowers have to pay a higher interest rate. They also understand that when they lower the riskless rate, they're moving the whole credit surface. And maybe they're actually flattening the credit surface. Well, if that's what they think they're doing, they should be saying it, and they should be expressing their policy in credit surface language. So they should say it's just not the riskless interest rate that we're trying to lower. We're trying to lower all the interest rates, and we expect that by lowering the riskless rate, we'll also bring down some of those other rates, and maybe by even more than the riskless rate went down. If that's what their goal is, which I believe in some of the cases it is, they should be saying it and measuring their success in compared to what they said that they wanted to do. And then I'm even more radical. They won't want to do that because it'll pin them down to too much precision that they probably don't think they can match and could be embarrassing, so they're going to be reluctant to do that, but I think they should nevertheless. And then the third thing I think they do is what Michael asked me to do. If they think that certain parts of the credit surface, the rate is too high or too low, they should intervene in specific parts of the credit surface to change it. And so it's a radical proposal that I don't think they're ready for. Maybe some people don't even think is right, but that's what I imagine when I talk about monetary policy.
Let me try to answer a couple questions that were addressed to me. But I first have to respond to the last comment that John made. In fact, the recent efforts of lower interest rates, in fact, negative interest rates, have actually led to lower interest rates, not in terms of real lending, but in terms of risk spreads. And the general worry is that they've come down too much. And the reason that, so while in financial markets they've come down too much, which represents a risk because when they get undone, there'll be a lot of asset volatility, it hasn't translated into real lending. And so the real problem here is, a lot of it you've been talking about is about financial markets, and a lot of what monetary policy should be about is actually generating economic activity, which is lending activity. And the Fed hasn't done a lot to, where it needs to intervene are, now this is where I do agree with you, either do lending itself or think about how to increase the flow of credit in the financial markets. For instance, by other mechanisms, like they've had requirements for minority lending, CRA requirements. The real shortage right now is SME, small and medium-sized enterprise lending. They could impose SME requirements. And I would feel better with that than the Fed deciding to lend money to GE and some other friends of the government, of the people on the Fed or something, and saying, let's let the banks do it, and let's make sure that when we lend money to the banks, they use that money for the real economy, like for SME, where there's a shortage of funds. So to me, that's an alternative instrument. And I think there is real risk associated with the negative interest rates and the effect on risk premiums at the current time. On the question of default, I wanted to say that John is absolutely right that in a way, default is part of a contract. A contract is I promise to pay except when I can't. And the legal framework defines when it means to be I can't. And so whenever you borrow, that's part of the understanding. Now, the question, I guess, that one might have asked is, if it was so good to have that debt forgiveness, it seemed to be Pareto superior, why didn't everybody do it? And I think one of the answers to that is that, in fact, the regulatory framework of how they assessed bank capital said that even though the asset wasn't worth very much, you don't have to write it down. And in fact, the administration did something even worse. They went from mark to market to mark to hope, which said that if you have any hope that this will be repaid, you can keep it at full value. Well, then the bank faced the problem of liquidity and constraint that if it did this write-off, it had to write down its debt, write down its capital. And if it wrote down its capital in this kind of after-crisis environment, it would either have to raise new capital, which was very difficult, or it had to cut back lending, which would cost it a lot. So in fact, it was the way the accounting regulations that actually were impediment to a Pareto superior outcome. But there were a lot of attempts. It was interesting. There were a lot of attempts in Congress to do these things, and the banks pushed back very strongly, which raises question about whether they knew what was in their own interest, because you would have thought their response should be, yes, but allow us to change the accounting. The government should have changed the accounting framework, and then that would have incentivized that restructuring. On the two other questions, on the Arrow de Brue question about how do we get back to full employment, given that the model says there ought to be a full employment, I didn't say that the model was right, and that there are lots of problems in wage rigidities. And what I was trying to emphasize, and obviously the right thing to do, I think, is recognize that there are those rigidities, and that adjustment in prices would themselves have very strong distributive effects, but to have other forms of intervention, like macroeconomic interventions, to get back to full employment. What I was really trying to emphasize was the point that all the emphasis on debt that one hears all the time is really testimony to the fact that people don't believe that the competitive equilibrium model is the correct model. Because if they really believed that model, they would say, it's just somebody owing money to somebody else. And yet there's this cognitive dissonance. They think debt is matters, but they also say they believe in the competitive equilibrium model in some version. And I think those two ideas, one shouldn't be able to hold those two ideas at the same time. As far as the 21st century Glass-Steagall Act, I think this is generally, the point is that we've seen excessive risk-taking by the banks. We've seen all kinds of bad behavior by the financial sector. That the Glass-Steagall was a structural reform designed to inhibit certain types of bad behavior so that you could have commercial banks that were regulated in one way and investment banks in another. It was never intended as a panacea, and in the 21st century we'll need both structural reform and behavioral regulation. I don't think that a 21st century Glass-Steagall is going to be sufficient for addressing the problems. I think we're still going to need to deal with the problem of money market funds, shadow banking, investment banks. But I think just doing the behavioral regulation, trying to regulate the behavior is extraordinarily difficult. As one of the regulators told me, the banks don't allow there to be any space between the wall and the wallpaper, and if there is, they'll come in and exploit it. So the point is that one needs a more comprehensive system of regulation, including macroeconomic prudential regulation. Well, we've used up our time, but before we end, I want to know. You want to?
Anything?
Ken, you want to? Well, let me just thank everybody for coming once again. Thank the Columbia University Press, who's been publishing all of these lectures, which have been extraordinarily good. When we started the series, people were we're not confident that we'd be able to not only continue the series, but actually have books that came out of it. I want to make sure that John writes up his wonderful lecture, and so that other people who have a chance to read it. And thank Ken once again for joining us. That really makes this a very special event.